If you're a small company trading in one market, do you actually need a complex risk model to tell you what's going on? Having put together a model, how do you define the processes within it and changing that model? How do you validate the use of that model? How is that model used in the decision-making process? Is the level of data that you are having to use in that model sufficient for the decisions you're making? So risk modeling is an important component part of enterprise risk management that we want to see being used to drive the business ahead, to rationalize the decisions that are being made. Strategic risk management. When Standard & Poor's is talking about strategic risk management, we're talking about the optimization of the risk-return profile in the organization. It reflects the fact that capital is usually in short supply, and somebody has to make the decision whether to finance an operation to grow in Libya, or finance an operation in Syria, or finance an operation in China, or finance an operation in Latin America somewhere. How will that capital application be managed? So we want to see a consistent view across all the business risks when a company is using strategic risk management. That the planning and processes used in strategic risk management are there to optimize the risk-return profile. That there is a track record of optimizing risk-adjusted returns on an economic basis. We want to see consistency. The influences of the risk-return consideration on capital management, investment allocation, pricing, performance management, and sales incentives. So when you give your underwriter a 5% pay increase, how has that been determined by reference to the risks he's actually taking? Some markets are easy to expand into. Should the individual expanding his business profitably into an easy line be remunerated more than an individual who's cutting back on business because it's losing money? Which would you rather have as an organization? Growth that's making profits? Or growth regardless? Or do you reward an individual who's controlling growth into a loss-making market? So these are the decisions we want to understand that you're making. How is performance monitored relative to the plan? How are negative deviations managed? In summary, we will assess strategic risk management as strong, where the insurer applies risk-return considerations when making strategic decisions. And the insurer applies risk-reward optimization consistently across different risks and business units. Has the money that you have invested in a particular venture actually given you the return you were expecting? What lessons have you learned by making a commitment of X units of currency to develop a business line that after 3 years has not delivered, when your initial target was to make a 10% return by the end of year 2? Can apply numbers to everything, but it's the understanding of the process that we want to see. So, let's look at risk management from a European perspective. Solvency II is the regulatory framework that is now being slowly introduced across the European insurance market. It requires specifics on the use of risk management and internal models. So the regulators across Europe are expecting companies to set up risk models. And these requirements are demanding. Of course, there could be different risks that supervisors can interpret differently, but there is a coordinating body. The European Insurance and Occupational Pensions Authority is there to ensure consistency in the model application across the European insurance market. It's probably fair to say that enterprise risk management is, as a particular activity, if I can call it an activity, is a development that has grown out of the Solvency II Basel III recommendations, that companies need to be more all-embracing in how they're identifying the risks that they're undertaking. So ERM sits nicely alongside the Solvency II disciplines that are slowly being introduced into Europe. From our perspective, those insurers that fully implement the Solvency II principles are likely to achieve strong enterprise risk management in our assessment of the rating. Those areas where supervisors allow more latitude, they're probably going to come in as adequate. Those insurers that we assess as having weak ERM are probably not going to meet the European Solvency II requirements. And I'd emphasize that the bulk of our ratings at the moment, or our assessments for enterprise risk management, are mostly in that adequate category. Companies are really struggling to come to grips with the Solvency II requirements and implement them in good fashion on a timely basis to their operations. So, what we as a rating agency expect is that Solvency II and the associated risk control frameworks that are going with that will raise the level of risk management governance standards across the European market. It will raise internal control levels for the insurance community. It will certainly raise the quality of the internal models. And those internal models have to have outside reviewing in order for them to be validated and used under the process. And so strategic risk management, as we define it, will be raised. Overall, Solvency II is expected to lead to improvements to the quality of enterprise risk management in European insurers. S&P analysis highlights deficiencies in risk management frameworks which may lead to capital add-ons in our or the supervisor's capital adequacy assessment. So we're still looking at the capital adequacy of companies on a risk basis. How much capital is required to support the different types of risk that insurers are undertaking. So Europe, we see a generally beneficial introduction to the security of the insurance community across Europe. Let's turn our mind now to the Gulf region, where I think the story is clearly very different. There is no single regulatory authority in the Gulf region. It's not my job to say whether that would be a good idea or not. But we now know that here, corporate governance disciplines are a feature of company life. Companies have had to adapt to this. It still is an area of criticism, I would suggest, for Gulf companies, not just the insurance community, but the others as well, that the level of corporate governance needs to be enhanced. What is obvious is that the GCC insurance supervisory bodies have not really developed an enterprise risk management concept for the insurance sector. It continues to be very much a voluntary exercise for individual companies. We talk to all of our rated clients about their enterprise risk management. Some of them have increasingly sophisticated levels. But what I think it is fair to say is that the dominant GCC insurers tend to be domestic operations. So there is limited external competitive spur to develop more sophisticated levels of enterprise risk management. And also, putting it into the context of what the rest of the world is looking at, the relatively obvious lack of severe regional insurance losses perhaps tends to reduce the apparent need for greater levels of sophisticated enterprise risk management in the Gulf region. But as the slide that's coming will show, investment management is a risk factor. And we have seen significant volatility in that area that greater levels of management skill could be applied to. The discussions we have with our rated clients, generally the S&P definition, the European definition of enterprise risk management, is only slowly moving up companies' operational agendas here. It is those companies that are moving outside their narrow domestic borders into more distant operations, be it within the GCC, the Pan-Arab North African world, that are tending to want to look at more sophisticated levels of risk management techniques. But it is fair to say that the reinsurers we see have adopted enterprise risk management to their general benefit in providing a more stable framework for them to work to. So, enterprise risk management. An example. This slide shows the way that the stock market indices across the Gulf have moved since the end of 2007. The two columns on the left show the absolute movement from 2007 to 2011, December 2007 to December 2011. And you can see that the average over this region of 7 indices is a decline of 42%. Only Qatar has managed to sort of stay up there with a decline of 8%. If we look at that year on year, at the end of calendar 2008, the regional markets had declined by 45%. In 2009, they rose 5%. 2010, they rose 8%. 2011, they fell by 7% overall. But within those 7 different indices that I'm showing, there's a considerable range of volatility. And the one that stands out is obviously Dubai, down 72% in 2008, down 17% in 2011, down 77% in the year of in the 4 years to 2011. Bahrain, significant damage caused to the investment markets in 2011. So that sets the scene for the investment markets that some insurers are participating within. We try and interpret that into what's going on. Statement of the obvious. GCC stock markets are very volatile. For many insurers, equity investments are a major asset class for them. We know that real estate is as well. Those companies with high levels of investment leverage, I left the word inequity here by mistake. When I say investment leverage, I'm looking at the level of equity investments as a percentage of shareholder funds, real estate as a percentage of shareholder funds, can expect corresponding volatility in their latent shareholder funds, if I can use it like that. Let's go back. A company in Bahrain in 2011, if it had equity investment leverage of 100%, that is that 100% of its shareholder funds were invested in the Bahraini stock market at the end of 2010, without some active management of that portfolio in 2011, we would be expecting to see something like a 20% decline in the value of those investments. It's clearly an oversimplification, but that is the mindset that these numbers are telling us. So if that company is to make a gain in shareholder funds in 2011, it has to cope with a built-in decline from its investment portfolio before it can show real gains to the investors. That is the risk that needs to be managed. And this is where we would like to see companies developing greater levels of application, I think, of the risk management techniques that we're talking about today. And I think also that when we look at the underwriting side for the GCC community, the delivery of attractive returns at the underwriting level is very often dependent upon the reinsurance protection that they're taking. So to what extent are they correctly managing the risk exposures from that reinsurance program? Or do they have the ability to continue to squeeze rates and maintain their profitability? So, ladies and gentlemen, that's a snapshot of enterprise risk management that we see in the GCC region, contrasted with Europe. A walk through S&P's approach to risk management as part of its rating process. Those of you who wish to talk further, this is the contact detail for me. And that's the end of the slide presentation. Thank you very much.